G'day expats, welcome to another episode of Expat Chat. I'm joined today, as always, with my co-host, friend and colleague, Brett Evans, Managing Director for the EMEA region. How are you going, Brett?
Mate, all good in the hood, And for the folks out there who can't see the better looking brother of mine on the left of screen, if you're listening on podcast, his name is James Ridley and he's the Managing Director for the APAC region. G'day, mate.
Now, listen, Brett, really good episode today. It's an episode that always, I guess, grinds my gears because
mine too.
I know. And you're probably more exposed to it over there in the sandpit than I am. And I mainly capture and try and help clients that are mainly in sort of the Asia Southeast region because there's plenty of them as well. And it's this offshore bond or investment bonds. I believe we've talked about it before. I think we've done a few articles on it, but they just keep getting sold to expats and people keep getting caught out. And we're really just trying to communicate, I suppose, to our audience and our clients that they're not these tax-free amazing investments that you get sold on. And I guess we're going to deep dive a little bit into it today and just try and make a comparison, factoring in fees, taxes, inflation, interest rates, those sort of things, just so we can paint a better picture for you.
Yep, and today's episode's name is When is a Tax-Free Investment Not Tax-Free? And we both put that in inverted commas as well too. Just quickly, we need to do our little disclaimer. Yes. What you're about to hear, see and embellish, or we're embellishing, you're listening, will be please be perceived as educational and informational purposes. There's no steak knives coming along, but it is a informational scenario. Please don't construe this as personal advice and speak to your professional.
Man, I've got to get you to write this all down because when I do our other podcast with Jeremy for Mortgage Side.
Good shout out for, by the way, the Expat Mortgage Podcast. If you're keen to talk about expat finance and stuff, subscribe to those guys. Not as good as this one because I'm not on it. But
it's true. I can't talk the way you can talk with all your different stories and references, and just I guess the legal disclaimer. I'm not as good as you, Brett, but I'm happy to admit it, and that's okay. I think maybe I've got you on the looks, hopefully.
No, mate, I've got the gift of the gab. Unfortunately, it can be a curse and a blessing at times. So just ask my wife.
Now, mate, let's dive in. So. I'm going to give you an example of a recent case I had with a client. They're in Singapore and they've been sold one of these. There's a Friends Providence account, but it was an investment bond. And Friends Providence International, that's just actually an investment platform, but you can have these types of investment bonds on there as a means to invest in shares, ETFs, those sort of things. And the way they're structured, it's a formal contract. It is a contract that you're entering into. In essence, you're entering in the contract with the advisor, or I like to say the sales consultant. And essentially, the
just on that too, just as a bit of a fill in for the folks out there.
Yeah,
I would say at a guess, 90% of the people selling these things, their only licensing is to sell insurance, not invest. They're not investment professionals. They're not investment advisors. They're not regulated investment professionals. So they're there to sell a product, which is an insurance product, which also happens to dovetail in that investment component. So just thought I'd just put that out there as well too. So keep going, mate.
Yeah, no, exactly. And I mean, it is, I guess, a formal contract that you enter in where the process that usually gets signed up on these is you'll have a meeting. They'll take you through, I guess, your first meeting, a PowerPoint on, wealth accumulation and ways that you can create wealth. And these are the ways they do it. And it's often promoted as a 25 or 15-year plan. And in essence, that's actually the sort of the coupons and the savings plan that you have where you're contributing into it. And then if you want to pull it out early, which they never talk about in these types of, I suppose, in presentations, the ability to withdraw it, there's very large exit fees and penalty fees. And the main reason being is because when you put in your initial capital, and as an example, you put in 100,000 AUD, that broker or that sales consultant sold the bond to you, they get paid about 20% of what you've put in. And that's an upfront commission. And then because the plan is designed around a 10, 15, 25-year plan, that's why there is such a large exit fee. If you were to turn around in 2 years' time and say, oh, I want to withdraw my money, Well, they're going to let you withdraw it, but there's going to be, say, an 18% exit fee now. So they'll still keep the amount of commission that's actually been paid out to either the advisor or the advisory firm that sold you on it. So that's why there are very large exit fees. And that's why when you look at the return of these types of investments, they've got a lot of work to do to recoup that initial 20%. They're further helped by you contributing to these on a monthly basis of anywhere between $500 to, a couple of $1,000. And then as time goes on, there's different components, but that's just a high level example. I've had a few clients come to me that have signed up to them before they've engaged us, and we've sort of worked out ways to unwind as much as we can without them getting charged exit fees. And then we kind of have to leave an amount on the table and just shelve it and go, listen, we'll withdraw that, but we'll wait until that exit fee winds down. Let's pull out what you can and, let's send it back to Australia and get it all, I suppose, set up for when you choose to repatriate eventually. So it's just being mindful of that. But that's usually how you're onboarded. It's through some sort of presentation, savings plan. Don't tell you about the exit fee, your ability to withdraw, and off we go.
Very smooth sales pitch. And I think that the two key things, because we actually help clients on a monthly basis wind these things up, even with the penalties. And this is one of the things I wanted to talk about today, because I had a meeting with a client yesterday, and he's been suckered into getting into one of these 10-year bonds. And what I was saying to him was that he kept going on and saying it's tax-free, it's tax-free. And I said, well, technically it's not tax-free. He's like, well, what do they lie? I said, no, what they're not disclosing, because they don't have to, there's no legal precedent that they have to do this, is they don't have to tell you all of the fees.
Yes.
That are the ongoing fees. Now, on average, and this is on an average basis, we've seen worse than this, on average, the average annual fees are between 4 and 6% per annum. Yep. So put that in your mind, 4 to 6% per annum, you're paying, custodians, platform providers, insurance salesmen, there's many mouths to feed. And that's why it adds up so quickly. They might disclose to you, oh no, we only charge 1%. That's them, not everyone else. Now, where it gets really convoluted is that you're always sold on this product that, by the way, hasn't been sold in Australia or the UK for the last 30 years because it's so bad, but let's leave that aside. We've discussed that ad nauseum in the past. If we look at an average rate of return of, say, 8%, and you put your money into the market, you should be getting an 8% return every year, year on year, compounding. Some years better than others, but on average, we're looking at 8%, depending on your risk profile. If you're giving the platform provider, the custodian, the insurance salesman 4 to 6%, you're giving between 50 and 75% of your returns to them. So essentially, you're paying between 50 and 75% tax.
Yeah, that's right. And that's why these investments don't do too well at all. I remember about 2 years ago, a client came to me and they had about 450,000 locked away in one, which I guess it baffles you, but there's a lot that's still unknown about when you're an expat, your ability to what you can do back in Australia investment, but you can still invest back in Australia. We'll go into it, but he thought the bond was doing really, really well in terms of its investment performance, and he was able to pull amounts out along the way. And when I went back and had a look at his withdrawals, what they had done the modeling on in terms of his guaranteed return, can't guarantee returns. I think they're doing it off about 6.5%, 7%. When we went back and had a look, his annual return was about 1.5% after all the fees. So it was a little disappointing and very sobering to sort of go through an analysis of it because he just wasn't aware. And that's the unfortunate part about these bonds. There isn't too much transparency. There's also the fact where they have the ability to change your investments. Usually they'll communicate that to you and go, listen, we don't like that market or that investment anymore, so we're going to move you into this one. What they don't tell you about that investment switch, because these bonds and investments are a bit unregulated to a degree, whenever they switch you over, just remember that they often get a commission for moving you into a new investment or a new managed fund. That investment or that little upfront kicker that they get is anywhere between, I would say, 1 to 4%, depending on the initial investment.
I've seen 10.
So, or And just
Yeah.
remember, if it's that high commission or entry sort of fee when you're buying into it, it means if you were to withdraw it straight away, automatically you're going to have 10% missing out of the amount that went into that managed fund because they've already paid that to the advisory firm. So you've just really got to be mindful of that. And then, I mean, going into this concept of tax-free, you know, Brett addressed it really well before about the high fees, but just remember that if you're investing in these sort of investments and you're in the Middle East, it's a tax-free area. So, you know, don't lock yourself into a bond when you don't need to.
Yeah.
Because there's no point. You know, you can set up a straightforward investment account, invest in index funds or direct shares and you're fine. And then back in Australia, because you're most likely going to be a non-resident for tax purposes, there is no tax that accumulates on a direct share portfolio. And the reason
Non-taxable
why,
asset.
that's exactly right. It's a non-tap asset in the eyes of the ATO. If you know you're going to come back to Australia at some point in the next 3, 5, 10 years, well, if you want to, I suppose, reduce your currency risk at the end of coming home, then you should be transitioning some funds back, taking a dollar cost averaging approach. It's spreading out your currency risk. It's more of a methodical and robotic way to handle that currency risk, less emotion in it. And it's probably considered the most conservative approach rather than holding all your eggs in one basket being a different currency and then trying to time when to come home. We've seen it go wrong many times with the pound, with the US dollar years ago. So it's just those considerations. But yes, I suppose taking the tax argument further, years ago, as Brett put it, these bonds were sold in Australia. They're mainly sort of an investment / insurance bond. Back in the 90s, door-to-door salesman locking you up in them. Yep, that's right. So, and they don't exist anymore because they're too unregulated, too many commissions, too high fees. So legislation was introduced to remove those conflicts, which is really, really good. So Australia, we're now in a situation where I'd say most conflicts have been removed for selling any managed funds or those kind of products.
Yep, no grandfathering commissions, none of that sort of stuff.
Yep, exactly right. Secondly, the ATO doesn't treat this offshore investment bond or insurance bond as a tax-free investment. It treats it as a Section 99B foreign investment trust. So what does that mean? Well, it means that from the day that you open this bond to the day that it's closed up, you know, if you open this bond and you've been overseas, a non-resident for 10 years, and you've owned that bond for 10 years, and then you come back and you're locked into a 15-year plan, so you can't pull out the funds because you get hit with that exit fee. When you come back to Australia, you don't pay tax yet on that investment, that capital that's in there. But when you withdraw it, all the growth from when you first open that account, that is accessible by the ATO. It's treated as foreign sourced income. Any contributions that you've kicked in along the way, well, that's made up and treated as the corpus. So that's tax-free in the eyes of the ATO. And that's good because most of the money that you kick into these bonds, you're putting in from your after-tax dollars, depending on where you are in the world. So it's good that the ATO acknowledges that component, but all the growth from when you first opened it is still accessible, foreign sourced income. So it is ridiculous that they promote these things as tax-free. The ATO doesn't see them as tax-free. So you've just got to be mindful of, you know, really questioning what you're being sold on and why you're doing it when you've got plenty of options back in a much more regulated environment, which is actually Australia, your home country.
And I'll take it a step further there, and using that, you know, the example I provided before about paying between 4 and 6% fees on an 8% return. Usually how these things are sold, and I actually had this discussion, I guess you could say, with one of the shiny suit brigade, I call them. You know, they wear the three-piece suit. You know, they've had exactly, but you know, for some reason, they're still like anyway. I'll let that by the way.
They're like real estate agents to a degree, aren't they?
Oh, look, you can see them coming a mile away, and it's almost quite humorous. And I sometimes seek them out just to, see what's going on. Anyway, you know, the discussion came around, you know, why we don't recommend these to expats. And the example they gave was, if you're in the Middle East for 5 years, you save, you go back to Australia, you know, if you commit to a 10-year bond, then that 5 years when you're in Australia is tax-free. And I politely, you know, use the example you gave with Section 99B and explain why. But I said, let's ignore that for a second. Let's say the ATO did agree with you. If you look at the scenario I gave before, about 4 to 6% returns, 4 to 6% fees on an 8% return,
Yep.
you're essentially paying tax at 50 to 75% for the 5 years you're away. And
Yep.
when you're back in Australia for the next 5 years of that bond's life, you're still paying tax at 50 to 75%.
Mm.
So in actual fact, you're better off just setting up a standard investment account while you're an expat, investing money back in Australia, paying no tax for the 5 years. And then even when you return to Australia, and if you are at the top marginal tax rate of 46%, you are still financially better off at the end of the day.
Yeah.
And
Yeah, absolutely.
we meet people on a daily basis who've got these things. And, I talk to them about the underlying return. Now, 9 times out of 10, when you look at the statement amount, there's a lot of smoke and mirrors and, pardon the French, a lot of bullshit on that statement. Majority of the time, the number they're quoting you as your balance is not the real number.
No.
It's a number that is there factoring in all these little bonuses that you're entitled to that give you the impression that it's worth a lot more than it actually is. So the way you test this is you send in a surrender request or redemption request, and then you find out what the real number is, and then they'll give you the number that they'll pay out. That number, that higher level number that they give you, is normally about 20% less than the number that's on the statement that they get out to you, and the number, depending on what bond you signed up to and how far through the process, or through the time frame you are, the surrender value will be quite different. Where it gets interesting, and we did this case last month for a client, is, she was in a 10-year bond, 56% penalty to redeem it at year 5.
Gosh.
All right. So she's got to walk away with 44% of her balance. We went through and looked back for the last 5 years at the rate of return that she would have received in that last 5 years and what she actually received. And believe it or not, she was financially better off to take the penalty, pull the money out, and then invest it appropriately. And we modeled for the next 7 years what that would look like. And she was ahead by 37%.
Yeah.
Even after taking the penalty. Every time we meet people who have these bonds, and 9 times out of 10, year 1, year 2, their radars have gone off and they realize it was the wrong thing to do.
Yeah. When
they do this, we often say, if you get your money back at the 10-year mark, you're doing good. One I had a meeting with on Monday, we annualized his rate of return for 10 years at 1.12%.
Yeah.
Now go back for 10 years. We're in 2022 right now. So that goes back to 2012. From 2014 to 2020 or 2019, the market had a great run.
Oh, yeah. Big time.
He's been paying someone else's, Ferrari bills or whatever these guys buy with all their money. Who knows? But, and that's one of the reasons why we want to talk today. It pisses me off. It really does, because these people have no accountability. If things go sideways, more often than not, by the time you realize it, that person's left the firm. He's either selling used cars or used carpets or something else somewhere else. They've got your commission, and the firm goes, oh, well, we did everything right, and there's no accountability. There's no way, there's no recourse. There's no way you can escalate things. And that's the biggest thing we talk about with clients is it's not the good always. It's about what happens when it goes bad. And the biggest thing we talk about with clients is the fact that whoever you're dealing with has to be able to be held accountable, whether it's the individual, whether it's the firm, doesn't matter what it is. And there are so many people, especially in the sandpit in this region, who use Band-Aids to say they've got what they need in order to achieve that. And the honest answer, and someone said to me the other day, blank piece of paper, if you want complete conviction that it's being done right, what should the setup be? And they said the setup should be one firm, one regulator, professional indemnity insurance, and accountability. And it's when you have all these layers about who's doing what and cross-selling between firms, that doesn't work, because the other firms, they're just going to point to each other and say, no, it's their fault, and you will get nowhere as a consumer. The other issue as well too is anyone who's trying to get recourse through the Isle of Man will tell you it doesn't work. Right now there's a massive court case where the courts ruled against some bad promotion and bad products. And right now, I think I saw an article about a week or so ago, there's still 2.5 years after the court said you to pay these people back their money, and they haven't paid them back the money. So, And that's one of the benefits. I mean, why you would repatriate money back to Australia. It might be geopolitical, it might be sovereignty risk, it might be all these governance risk. At least in Australia, there's a system there, like we've seen from the Royal Commission into banking. The billions and billions and billions and billions that Australian companies have paid out to investors because they did wrong. There's that accountability piece is the biggest thing. Now, when you're away from your money, you're 14 hours flying time away, and that gives you that peace of mind because you know that even though you are in the UAE or Kazakhstan or Saudi Arabia or wherever it might be, that you receive this, crap advice, you know you can pick up the phone to an Australian regulator, lodge a complaint, and it will be actioned. It won't be swept under the rug. And that's what we see on, I think the record I've seen so far with one client was 7 different advisors from the first guy who sold it.
Oh God!
On this person's account, and
are they holding that? It sounds like they're holding that bond for too long, but
this firm was just going through that many advisors,
churning
advisors as well as.
Well, that's the thing. You see these ads over in the sort of the sandpit in the ad area, in the GCC area, or even the Southeast Asia, where the recruiters go big. They promise these guys like an amazing lifestyle, but these guys, it's a case where they eat what they kill, and if they're not obviously killing anything, they have to move to the next firm. They sort of get 1 to 3 months probation. Okay, you haven't signed up anything, you haven't made any commissions, off you go. So that makes sense that person had 7 consultants over maybe a couple of year period.
Yeah, it's to me, I said to someone there, but about 6 months ago I said, look, you don't know me from a bar of salt. I bring credibility because I'm Australian regulated, Australian registered, and all these things. But yes, let's ignore all that for a second. Look at the body language of the regulators around the world. Australia and UK banned it a long time ago. Hong Kong. Hong Kong's now limited and it was 2017, I think it was 2018, in terms of how much upfront commissions these people can get because they knew themselves, the regulator, that this is wrong. Last year, a rule came through, BOD 49. Same thing again. They've started the process here. If the regulator was pushing this down so much, would it be wrong? Yeah, that's the thing. It's not just our opinion. 2 mugs, buddy, jumping on a podcast having a chat about this. It's highly educated regulators who also know that this is wrong. So, and these people will continue to do it until it is completely ruled out. Who knows when that will be? Might be another 5 years, might be 10 years, might be 15 years. Who knows? All we can do is get on the hustings and just let people know, run a million miles when this stuff comes through.
Well, I always feel like maybe it's just, it always comes down to, yes, a lack of education around that specific financial product, but also not knowing what your alternative options are, So I guess we've talked about them, talked about at length now, investment bonds and why they grind our gears and be very, very careful of them. Your alternative options are straightforward, investment account back in Australia. It's in AUD. It's trading, either, your ASX blue chip shares companies, or you can use international ETFs, index funds. That makes sense. That's giving you good exposure to the overseas markets. You made a good point before about how, 5 years tax-free because you're a non-resident for 5 years. That makes sense. And then just remember, there are other strategies when you come back to Australia to employ to keep it tax efficient. I'm not going to say tax-free, but
tax
this
optimized.
Yeah, that's right. So depending on your age, retirement, those sort of things, you've got your superannuation that you can squash it into. You've got things like a newly created discretionary trust with maybe a bucket company, a corporate beneficiary. That means you're only paying a flat rate of 30% tax on income and capital gain. So there's plenty of avenues you can take once you come back to Australia to keep it tax optimized or tax efficient, and you're not paying, your highest marginal tax rate on it. So it's just being mindful of that you don't need to, I suppose, sign up to these offshore bonds when you've got other options. And even outside that, if you're working with the right advisors, whether it's in Australia, outside of Australia, offshore, they shouldn't be trying to get you in a bond. If you want access to your money and liquidity and you want to be, reassured by that, they should also be able to offer just an investment account. They shouldn't be trying to squash you into this 10, 15, 25 year investment bond. If they can't offer you something that's simple, highly liquid, something you can access,
Yeah, transparent.
then exactly right. Then you just turn around and go, no, thank you, not for me. You've tried to sell me this bond a few times now. I'm not into it. I'm concerned that I'm going to accidentally sign something that gives you too much authority.
Unfortunately, most of the resources of these firms that are selling these bonds goes into sales training. So they are very clever when it comes to their sales pitch. They know how to target your pain points and concerns and then provide you an answer. And they should spend more money on their suits. That's a given. But, and that's the thing. These people will sound really good because they're trained that way. They're not trained to give what we call best interest, results for clients. They don't have that fiduciary duty to give that to you. All the focus is getting a signature on a paper and moving on to the next victim.
Yep. Yeah, it's terrible to be honest, but
I think we'll wrap it up there. We could go on forever, but we just really want, I'm seeing this stuff on a daily basis. I know you do. It really grinds my gears, as you said before, and really, pisses me off just to see good people get bad advice. It just really pisses me off. So a couple of admin things. Heads up for the folks out there. We are running seminars and webinars later this month, early next month, with respect to both the federal budget update as well as touching on the tax residency changes. If you want to know more about that, there'll be a link in the show notes below. You can also go to our website, atlaswealth.com, go to the blog section. There's an article there about all the times and dates and registration links in there. We've also got our Australian Expat Financial Forum Facebook group. Jump on there. A lot of folks on there are just discussing all sorts of things about mortgaging properties and transferring cash and FX brokers and all those sort of things. So it's a very safe place for you to ask those questions that people do find difficult in managing their finances as an expat. And so jump on there. I'd love to have you on board. There's over 1,200 people there now, I think, in there, exchanging ideas, which is fantastic. And last of all, we do get reviews. Guys, please keep that up. That's fantastic. We, as you can tell by today's conversation, we're not selling Atlas. This is just letting people be informed, that, hey, you need to be aware of this stuff. Use us, use someone else. We don't care, but just don't be suckered into this sort of stuff. By giving us ratings and reviews on our podcast, it really helps get the message out there to a greater population, and unfortunately, people are still going to get sucked into these deals. So, just give us a bit of a helping hand there, guys. If you could just give us a review, we'd sincerely appreciate that.
Yep, absolutely. Brett, thanks for your time, mate. Thanks, guys, for listening in.
Thanks, mate. We'll talk to you soon.